Hello and welcome to eLagaan Whiteboard Friday, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at various types of shares or securities that can be issued by the company for various purposes like investments or taking loans and related stuff. Right? Shares is something which is also the ownership of the company. So when you own a share of a company, you own a particular percentage or something of the company. So shares is actually the ownership document. Now shares can primarily be of multiple types. The most common one is called the equity shares. So the word equity means it is equal. So any shareholder which has equity shares are all equal to each other. So there is nothing called he is better or I am better or somebody else is better. So equal rights is what derives the word equity. This is also called as common stocks in places like US and all. So this is the common stock equity share, which is mostly being used by all the shareholders, right from founders to employees to investors, everybody. This has certain voting rights associated with it and the ownership part of the thing. Second one comes is the preference shares. So preference shares, by the name itself suggests that these are preferential in nature. The major difference between equity and preference share is whenever a company goes for liquidation, the preferential shareholders get a preferential treatment over the equity shareholders. That means if the company goes into liquidation, then whatever remains by selling the assets and all would first be distributed among the preferential shareholders. Then if something is left over, then it goes to the equity shareholders' equity. Preference shareholders does not have voting rights associated, so that's the virtue of it. Preferential shareholders are also eligible to get minimum percentage of dividend on their investments. So again, if the company declares a dividend, then in a general scenario, the preferential shareholders would get it first. If something else left over for distributing dividend, then equity shareholders will get that. But in other scenarios also, you have some minimum percentage of dividend that can be issued to preferential shares. Most of the investors, when they invest money into your company, try to take a preferential share at least for certain period. Now preferential shares at a later date can be converted to equity shares. So but initial phase for the next 3 to 5 years, the investor generally prefers that you issue them preferential shares. Couple of reasons: in case if the company does not do well, then they would be the first to get the money back for their investment because from whatever remains in the company. Secondly, that's one primary reason why investors go for preferential shares. And then there is also a small amount of dividend that is associated with preferential share. So typically in any investments, investors would go with a preferential share with 1 or 2 equity shares, so that they get some voting rights into the company. Otherwise, during the investment period, if they hold complete preference shares, then they would not get much voting rights and they may not have any say into the day-to-day activities of the company. The third kind of category is equity shares with differential voting rights. So equity shares with differential voting rights is something you still hold equity shares, but the voting rights is not equal to everybody else. You can create a differential voting rights. This is typically associated with founders and directors or the key managerial persons of the company. So when they are allotted equity shares, there is an opportunity. For example, Google has recently done it, Facebook has also done it. So you allot the same equity shares, but the voting rights is higher. But as per the new company law, there are certain restrictions. For the first 3 years of your operation, the company cannot issue this category of shares to anybody, or the company should have a track record of about 3 years of distributable dividend. So the company should have been distributing the dividends to the shareholders before they can actually look at equity shares with differential voting rights and all. The fourth kind of a equity share is sweat equity. So sweat equity, again, as the name suggests, is a equity given for against sweat. So if there is a director or employees of the company who are rendering valuable services to the company, they are eligible to get sweat equity. So sweat equity is something which is given against the sweat. That means there is no cash transaction to buy this equity. Now, as per the new company law, none of these equity or debentures can be issued at a discount apart from only sweat equity or ESOP. So these are the only two kind of equity which can be issued at a discount. Rest all has to be issued either at a face value or at a premium. On sweat equity, coming back, the company should have already completed 1 year of what I would say operations. That is, from the date of commencement of business, 1 year should have already elapsed. That is one thing. Secondly, sweat equity can be given only after 1 year of the association of the employee. So if you are giving a sweat equity to an employee, they should have completed 1 year of service before getting a sweat equity. That is second. Directors, you can issue them on joining. So if you are taking somebody as a director today, you can still issue him a sweat equity before 1 year, but then the company should have already completed 1 year of operation. So sweat equity, that way, first, it cannot be issued before 1 year of your operation. Secondly, it can be only given to directors or employees. It cannot be given to promoters, that is the shareholders. So to directors, you can issue sweat equity on joining, but the company should have completed 1 year. To employees, you can give sweat equity only after they complete 1 year of association with the company. Now, before issuing any sweat equity, a proper valuation has to be arrived at. What is the equity that you are giving and how much is actually the worth of services that the company has received. So a proper valuation has to be arrived before you can actually issue sweat equity to employees and directors. And typically sweat equities have a lock-in period of 3 years. So even after you give them sweat equity, those people cannot sell the equity to anybody else for a period of at least 3 years. That's the normal trend. Now ESOPs, it is employee stock options. So right now it is just the option, but this again gets converted into equity shares whenever the vesting happens. Now there is no limit. You can you commenced your business today, you can start issuing ESOP, but the first vesting of ESOP can happen only after 1 year. It cannot happen before that. So the employee has to complete 1 year now before actually getting any vesting of ESOPs. And then after that you can decide what should be the vesting schedule and all. And secondly, ESOPs may not have a lock-in period. So again, depending on the company policy, if you want, you can put a lock-in period. If you do not want, you cannot. You may not put a lock-in period. The normal trend is ESOPs, generally people don't put a lock-in period. Third important thing in ESOPs is now it is restricted that ESOPs can only be given to employees, not to anybody else. So again, full-time employees, you cannot give it to consultants, part-timers, directors, advisors, mentors, promoters. Nobody can get ESOPs. ESOPs can only be given to employees, and that to full-time employees. And there is no specific valuation requirement here. It is more treated as an incentive that is given to employees to retain them and to motivate them for better performance. So sweat and ESOP both are again like kind of equity shares only, so they fall into this category. Now let's come back to debenture. Debenture is actually it falls under securities. So debentures is something where you are raising money, and then at a later point of time either the company would give back the money or it could convert it into equity. So there are primarily three kinds of debenture. One is called CCD, which is compulsorily convertible debenture. Secondly is optionally convertible debenture, and third one is non-convertible debenture. So when you issue debenture, CCDs would compulsorily convert to an equity share depending on whatever ratio you have decided and the time. So say if it is a 3-year CCD, so you take the money today, and then after 3 years these debentures has to compulsorily convert to an equity share. OCD would be an optionally convertible. So suppose again if it is a 3-year OCD, then at the end of 3 years, depending on whom you have given the option, if it is with the investor or with the company, they can decide whether these debentures should get converted into equity shares or not. Non-convertible debenture is just a plain debenture. It cannot be converted into equity shares. Now debentures typically carry a rate of interest, so it's actually a loan. So when you take this, you have to pay an interest on the debentures, which is paid year on year or quarterly, depending on whatever you want or how the company is structuring it. So these are this thing. Warrants is another thing. So warrants is actually an instrument which is actually issued by the company, where it would after a certain period of time get converted into an equity share. So warrants can also be traded. For publicly listed companies, warrants can also be traded. Earlier people used to trade a lot on warrants. So they give you money, and warrants can be issued along with debentures also. So when you give money to the company, they give you debentures and then they give you warrants, which can actually be converted into equity share at a later point of time. So these are primarily the types of securities and shares that is available with the company to raise money. So this is either for investment or for loans or to restructuring the company. That's it. Thanks for attending eLagaan Whiteboard Friday. Feel free to drop us an email at support@elagaan.com for any queries you may have here, or check out our knowledge base at elagaan.com/kb. Thank you. Thanks a lot.